Good morning, everybody. Welcome back. Today, before starting our in-depth analysis, I will quickly summarize the main takeaways of this video right here, since your time is precious. PayPal is a payment solution platform with a strong business, stable financial position, and a really strong brand value. And most importantly, when looking at this DCF model, we can see that currently PayPal is undervalued and it can lead to nice buying opportunities as it is currently valued for 0% revenue growth for the next 5 years. Something really rare to find in the stock market when considering high-quality companies like PayPal. Now, since the details of this model and the fundamental analysis is crucial, sit back and relax and let's start with this video, as I can promise you will not regret it. And remember to like and subscribe if you enjoy the content, as it helps a lot and is free to do. If you're new here, to analyze equities, I will use a 6-step valuation process which consists of the steps shown on the slide. Additionally, the DCF model used for the price target will be available to download in the description below. So what is PayPal? PayPal is a payment solution platform that enables customers to connect, transact, and send and receive payments from anywhere. They operate a two-sided network at scale, connecting over 435 million of active accounts. And PayPal earns revenues mainly by charging fees for completing payment transactions and other payment-related services, which are typically based on the volume of activity processed on payments platform. For the value propositions offered by the two-sided payment platform, in the merchant side, it helps with digital checkout, credit solutions, and various tools and protections. Meanwhile, for consumers, they help facilitate payments both domestically and internationally and provide credit with flexible payment options. For industry analysis, it is important to understand the most notable players in the transaction and payment processing services. There is PayPal, Block, formerly known as Square, Adyen, SoFi, Stripe, and many others, which are competing head-on with PayPal. It should also be noted that when looking at the price-return graph for the previous 3 years, all of the companies within this industry have been hit hard, with a drop of between 60 to 75%, giving really intriguing valuations for the long term, as we will dive in later. As we can see from this comparative table, when looking at the revenue growth, Block is the winner with a 21% revenue growth. However, it is lacking in the profitability metrics, an important factor in the current environment. Meanwhile, PayPal has consistent revenue growth ranging between 8% to 15%, with really good margins and a high return on equity compared to the competitors, with Adyen being a close contender. For competitive advantages, PayPal has a lot. To begin with, its distribution and reach, through PayPal having a large number of outlets in almost every state, supported by a strong distribution network, making sure that its products are available easily and quickly to large numbers of customers in a timely manner. Secondly, its brand and scale, with over 430 million of active users in over 200 markets, PayPal has entrenched itself in the global payment processor industry. PayPal's CEO is Alex Chriss since September 27, 2023, so they've just had a shift to a new CEO. Before, he worked for Intuit for 19 years, where since January 2019, he has served as Executive Vice President and General Manager of Intuit's Small Business and Self-Employed Group. The financial situation of PayPal is healthy. They have a cash balance of 9.9 billion with a total debt of 11.2, of which 10.55 is long-term debt. They have a low quick ratio, and when considering the debt level, they have been increasing year over year. However, when we think about the debt level and coverages, it is manageable in the long term with low risks of insolvency considering PayPal's profitability. As for its free cash flow for the second quarter of 2023, it turned out negative because the company set aside $1.2 billion during the quarter to pay off some bad loans, which is the downside of having debt. And the 1.2 billion negative impact from the European buy now, pay later loans originated as HFS. However, PayPal expects that the sale of these European BNPL loans later this year will be able to offset that decline and drive it towards the goal of generating 5 billion of positive free cash flow for the full year of 2023. For risks, PayPal has 4 main risks: the macroeconomic factors, the highly competitive industry it's participating in, the regulations, and possible brand damage risk in the future. For the macroeconomic factors, specifically the high interest rate, as interest rates are increasing, the cost of debt is going to be heavier, which can impact the free cash flow as we've seen in Q2 2023 and might happen again in the future. Secondly, the highly competitive industry that PayPal is in, if they can't innovate due to the lower competitive mode compared to other industries, then especially for the customer side, then they can lose a lot of value and active users, which will hurt the company a lot. Thirdly, the regulatory risk, because PayPal is operating in payments, cryptocurrency, and lending environments, every country regulates them differently, and therefore, with possible expansion plans or changes in regulation, it can hinder the growth and operations of PayPal in the future. And finally, possible brand damage risk due to an unexpected event could create a lot of value destruction due to the highly competitive industry nature with the low moat as mentioned previously. The price target from my DCF model is $85. And with a 0% revenue growth for the next 5 years, the price target from my model is $48. The current price is $50. And when considering the 37 analysts, their 1 year price target being $82, the value proposition of PayPal is very promising. This is my 5-year DCF model for PayPal, which yields a perpetuity approach value of 67 and EBITDA approach of 104. And when taking the average, it's $85, which from the current price of 50, it's a 71% upside. The inputs used to reach this value is, I extrapolated the revenue growth for 8%, 2023-2024 with a higher interest rate environment, slower, and then pick back up to a 10% revenue growth until 2028, which considering the historical path, I think is very possible. The cost of goods sold, I maintain the efficiency that PayPal has in their cost of goods sold, then extrapolated the depreciation and capital expenditure as a percentage of revenues. And these assumptions yield these 2028 values. When considering all these inputs, using a 21% applicable tax rate, a 10% discount rate, a 3% long-term perpetuity growth rate, we get the perpetuity approach value. And with an EBITDA multiple of 18x, we get the EBITDA approach value. And remember that right now I'm using a discount rate of 10%, but when the risk-free rate decreases, the discount rate will also be able to decrease, and the value of PayPal will increase drastically. For example, if we do an 8% discount rate, then the average price would actually become $104, which is a 110% increase in value. But currently, with the current interest rate values, a discount rate of 10% is valid. And then I also did a sensitivity analysis with the different revenue growth. And with 0%, we get a minus 4% downside. And depending on the type of revenue PayPal will be able to accomplish, we get these different values. In conclusion, PayPal has a strong business model, it's in a strong financial position, and it has a really good valuation at this time. PayPal has risk, therefore check the risk and reward for you, but personally PayPal at this level is a great buy. If you reached the end of the video, you're awesome. And if you enjoyed, please like and subscribe as it will greatly help and support the channel. Have a good rest of your day, and I'll see you next time.